Hey, Abby, good to see you. Today we are talking about the relatively safe investment that will soon yield almost 10%. I've only recently heard about Series I savings bonds, but a lot of people are talking about them and investing in them lately. That's because they are tied to the inflation rate. So I want to talk about what they are, kind of how they work, and whether or not an I bond is a good investment.
So very hot topic. A lot of
Right.
people probably this was never, in their vocabulary,
Right.
didn't even know that it existed because and that just really proves that inflation has been really not a problem for so long. I mean, the
Right.
the last time it was like this was in 1981.
Right. Look at that
And
number, 8.5%.
yep, exactly. And I mean, that seems like might as well, be 100 years ago at this point in time. So they just haven't been very popular. And so now people are seeing, okay, it's backed by the U.S. government.
Mhm.
So in that way, it's safe. Not everything has risks, but it is backed by the U.S. government. So that's pretty safe.
Right.
And then they're seeing the interest rate, which is there's actually two different components to the interest rate. There's the fixed part, which is zero right now, and then there's the variable part. And that's the one that's really attractive to people. That's the one that was, 7.12%. And then it's going to be almost close to 10%,
Right.
most likely coming up in May.
So that is seems like a good investment that way.
Yeah, so could be a good option for what we call lazy money. So money
Mhm.
that is just kind of sitting in low interest bearing accounts. So that's going to
Mhm.
be CDs, which are really certificates of disappointment right now. They're yielding absolutely nothing. Savings accounts, checking accounts that literally don't have any interest. So those or money market, they're not really yielding anything either. So we call those types of accounts lazy money. So
Right.
if you have a surplus of lazy money, and this is above what you really need for emergency savings. So you and I were just talking about that's going to vary depending on person to person. So figure out what you need for your emergency savings, and then anything above that, that's where you can start looking for better options. And
Mhm.
this is a
Mhm.
perfect time to do that because a lot of times what we see is lazy money. People have it there because it's safe. It's not in the market. They don't have to watch it go up and down and deal with all the anxiety and stress based on that. But they're actually losing purchasing power. They're losing money in that way. And so since inflation is skyrocketing, since the Fed is raising interest rates, this is bringing the more conservative options back to the table and making them really worth a look. So it's not necessarily if this is a good or bad investment. I think it's appropriate for a certain, a certain part of your portfolio, and it's a really attractive option for savings that are just kind of sitting there that you might not need for the next year or so. So
Right.
it's just whether it's appropriate or not is what I would say about that.
Right. So just to kind of put a finer point on that, what you were mentioning, savings accounts and CDs averaging 0.06 and 0.15% respectively. So you've touched on some of the drawbacks, but also there's it's illiquid for a year, right?
Mhm.
And there are
Yeah.
penalties if you take it out under 5 years, and you can only invest up to 10,000. What are the drawbacks do we need to keep in mind?
Yeah, so those are some great points. A lot of people are running out and getting them as fast as they can because they don't want to miss out, which I completely understand.
Yeah.
So a couple of things to know is that you have to get them directly from the government, and that's going to be a little bit of a tedious process at times because that's just kind of how it is with the government. So just kind of prepare yourself that there might be some snafus and there might be some patience that are required because the demand is so high.
Hmm.
You can only purchase up to $10,000 per person. So if you're a couple, you can do up to 20,000, and then also you can buy gifts for the spouse. So you can actually do up to 40,000. There's a certain way that you have to do that. So, but that is possible. You can also purchase them directly with your tax return. And this is very old school, but if you do it with your tax return, you're going to get the paper certificates in the mail,
Ooh,
which is interesting. Yep, that's very old school.
yeah.
That's another way to do it. You can do the 10,000 plus. You can use your tax return if you have
Hmm.
that. So you can
Hmm.
do that, and that's per year. And then another thing to know that you were mentioning is that this is actually a 30-year bond. But you don't have to keep it all 30 years. It'll earn interest for 30 years. After that, no more interest. There's no more reason to keep it. You cannot touch it within the first year. So this has to be money that you really will not need in the first year. If you cash it out between 1 and 5 years, there's a penalty of 3 months of interest. In addition to that, so like I mentioned before, there is that variable component to the interest. So there's some interest rate risk. So if inflation does go back down, there might be a period of time where it's not as attractive, and you might have to take that 3-month penalty to get it out and move it to something a little bit better at that point in time. So it still has interest rate risk, but for the right pot of money for the right person, it's a really attractive place for lazy money right now, and it's certainly worth a look.
Right. I feel like the takeaway here for me, at least, Abby, is that people are really looking for ways to invest safely but still guard against inflation. Is there anything that you are advising clients to consider other than I bonds?
Yeah, so since there's a limit to how many you can purchase, and they do that on purpose, so because there's really, this clamoring for things that are safe, because of the volatility that we're seeing in the market right now. People really want to feel secure. They want peace of mind, but they don't want to continue to lose money. So this is what we talk about too, where opportunities are created when, bad things happen, like inflation, market volatility, things like that. So because of everything that's going on, more conservative options are becoming more and more attractive. And there's a lot of, options out there that people don't know about. So annuities are one that they have gotten a bad rap in the past, but they're becoming more and more popular because they're not the same type of annuities as the ones from 10 years ago. Like a lot like cell phones. If you looked at a cell phone from 10 years ago and one now, they're completely different. So they've really come a long way. There's some that are principal protected. So that's that safe component that people are really attracted to. Some of them have even a fixed interest rate for a set period of time, kind of like a CD. And then others have guaranteed lifetime income. That's incredibly important for people, especially if you don't have a pension or, you just need a little bit more protected income, a little bit more, peace of mind, be able to sleep better at night. So that's one option. And there are several others. But this type environment we're in right now is creating some opportunities. So it's not all doom and gloom, and there are ways to really take advantage of what's going on right now.
Yeah, that's good to hear. All right. Well, Abby, this is complicated, but I really appreciate you breaking it down. It was very helpful. If somebody has questions about how to weather these periods of high inflation, what's the best way to reach you?
So you can go to our website at theretirementfamily.com. You can send us a message. You can ask for a complimentary consultation. I'd be happy to chat with you for 10, 15 minutes to answer your questions. Let me know what's on your mind, and just have a talk, or you can request an appointment with one of our fiduciary advisors, or you can give us a call at 678-442-0255 and contact us that way.
That's great. All right, Abby, thank you.
Thanks, Erin.